There was a clear theme on Wall Street today. Fundamentals matter. So does Washington, of course. But today, good old-fashioned numbers on profits, jobs, and interest rates mattered more. Investors had to take into account earnings and whether the results so far this earnings season have been good enough to justify today's lofty stock values. There was also the Federal Reserve, which kept interest rates unchanged and decided to keep the market guessing on when the next rate hike will occur. And then there were jobs and a report that showed private companies went on a hiring spree to start the year. But let's begin with the help of corporate America. We are at the halfway mark of earnings season, and while the results have been positive, there are some hurdles ahead. Bob Pisani breaks it down.
We're just about halfway through earnings season, and the results have been encouraging, with blended earnings up about 7% for the fourth quarter, and revenues are up more than 4%. That's according to Thomson Reuters. Those are pretty good numbers overall. However, there's good news here and bad news. The good news is the 2016 earnings recession is now over. But here's the bad news. Now the hard part starts. The markets are anticipating double-digit earnings growth in all the major sectors throughout 2017. That's a tall order. Is there any chance that corporate America can really deliver on these big expectations? That's what the market's grappling with right now. It's a tall order. And part of the problem with the markets in the last few days is maybe we're entering this period when the market is settling into somewhat more realistic expectations of what we're going to get. Here's why. First, the fourth quarter numbers are up. That's good news, but they're very uneven. Here's my worry. Only about half of the companies are beating expectations for revenues. That's way below normal. Now, that tells me that the expectations are already a bit too high, and that's just the fourth quarter. Second, corporations are being very conservative on 2017 guidance. No one is telling analysts to boost their earnings because of the Trump agenda or outsized global growth. At least nobody's doing that yet. Finally, traders are debating how much real earnings oomph we're going to get from lower corporate taxes. Remember, that's one of the main drivers of this recent rally. There's no doubt corporations will benefit from a tax cut. We all know that. But traders are now realizing that initial expectations that a tax cut could boost earnings 10 to 15% or more are probably too high. Now, finally, there's a much broader macro question the market's grappling with. Can the baton pass smoothly from easy monetary policy to easy fiscal policy? Now, if it can, there might be a smooth handoff, and earnings will rise enough to justify the current prices. But if not, it could be a rocky year for the rest of the markets. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.